Welcome back, everyone. This is a company where every time you swipe your credit card, they make money. Even if you don't swipe, they still make money. And if you miss your payment, they make even more. Now, here's something interesting. In his book, One Up on Wall Street, Peter Lynch talks about how some of the best investment opportunities are often in companies that are boring, overlooked, and not getting much attention from the Wall Street. And honestly, guys, the company we are discussing today, SBI Cards, you probably won't hear about it in daily news. You won't see it in trending on most of the YouTube channels because this is one of those boring businesses quietly growing its revenue, quietly increasing its profit while staying completely under the radar. And sometimes, before a business catches everyone's attention, that is exactly when you should start paying attention. So the big question is this a hidden compounding machine or a value trap in disguise? Let's break it down. But a quick disclaimer, I am not a financial advisor. This video is only for educational purposes. Please do your own research before investing. In this video, we'll first understand the business of SBI cards and payment services. Then we look at the financials, and finally we'll analyze the stock chart to see what is really going on. So let's start with the basics. What exactly does SBI cards do? SBI Card is one of the India's largest credit card issuers. It is promoted by State Bank of India, which already gives it a massive advantage in terms of trust and distribution. Think about it. SBI already has millions of customers across India, and SBI cards can tap directly into this huge customer base to issue credit cards. This gives them a very strong starting point compared to the competitors. Now, the business is actually very simple to understand, but extremely powerful. SBI cards give you a credit card, you use it to spend money, and they earn from that behavior in multiple ways. And this is where things get interesting. There are three major primary ways this company makes money. First one, interest income. If you don't pay your full credit card bill, they charge interest, and this is one of their biggest revenue drivers. Second, fees and charges. This includes annual fees, late payment fees, over limit charges, and processing fees. Third, merchant payments. Every time you swipe your card at a store, the merchant pays a small percentage to the card issuer. So, if you really think about it, whether you spend, delay payments, or just hold the card, there is always a way for the company to make money. Now, this is where the bigger picture comes in. India is still significantly underpenetrated when it comes to the credit cards. Compared to the developed countries, the number of credit cards per person is still very low. And as income rises, digital payment increases, and consumption grows, more and more people will start using credit cards. And that directly benefits companies like SBI Cards. Now, on top of that, SBI Cards benefits from strong brand trust because of SBI, wide distribution network, and partnerships with merchants and online platforms. All of this helps them acquire customers faster and scale efficiently. But this is not a perfect business because the same model that generates high returns also comes with risk. If customers do not repay their dues, it directly impacts the company's profit. So this is a business where growth and risk goes hand in hand. And that is exactly why you'll often see the volatility in this stock. So now that we understand how the business works, the real question is the company actually performing well financially? Are the profits growing the way we expect? And most importantly, is the risk under control? Let's dive into the financials. So now that we understand how the business works, the real question is the company actually delivering in the numbers? Because at the end of the day, a great business does not always mean a great investment. So let's look at the financials. Let's start with the top line, revenue. So if we go down, in the last 5 years, the revenue of SBI cards and payment services has grown from around 9,300 crores to nearly 19,600 crores on a trailing basis. That's more than 2x growth in just a few years. So clearly, the business is expanding, more people are using credit cards now, and overall spending is increasing. At first glance, this looks like a strong growth story. Now, if you look at the profits grew from 985 crores to 2408 crores in FY24, then slightly dipped a bit to 1916 and then slightly rose to 2092 crores in trailing 12 months. Now let's go one level deeper. The financing margin. which is a key profitability indicator for this business, has come down significantly. So it went from around 19% at its peak to 11% recently. That's a sharp decline. And this tells us about either the cost of funds is increasing or credit losses are rising, or both. And this is exactly where the pressure is building. Now, here's the interesting contrast. The number of cards in circulation has crossed 2 crores and it continues to grow steadily. But more importantly, the total spending on these cards is growing even faster. In fact, spending has been strong double digit growth, which means customers are using their cards more actively than before. So, on the surface, the business looks very healthy. But now look at this carefully. Spending is growing fast, customers are increasing, revenue is going up. And yet, profits are under pressure, margins are declining. So, the big question is, where is the problem? The answer lies in one key factor: credit risk. In a credit card business, if customers don't repay, the entire model gets impacted. And even though the company's asset quality remains relatively stable with NPAs, if we look at NPAs around 2 to 3% range, any increase in defaults or credit cards can hit direct profitability. And that seems to be what the market is worried about. So, what we are seeing here is a classic situation. The business is growing, no doubt about that, but the quality of that growth and the cost of sustaining that growth is now coming into question. And this is exactly why, despite strong revenue growth, the stock hasn't really performed the way many investors expected. So now the real question becomes, is this just a temporary phase or is there a deeper structural issue in the business? To answer that, let's look at the stock chart. Now, this might surprise you. The stock is currently trading at around 640 levels, which is almost the same price where it was listed back in year 2020 2021. So essentially, if someone invested at the time of listing, they have made almost zero returns till now. And that is despite the business is growing in the last few years. In fact, right after listing, the stock rallied sharply and touched level of around 1150 rupees. At that time, everything looked perfect. Strong growth story, rising credit card usage, positive sentiment. And the market was pricing in a very bright future. But after that peak, the stock corrected sharply, which is nearly falling by around 45%. And since then, it has really been able to make a new high. Instead, what we see a pattern of going up, coming down, then going up again, then coming down again. So basically, the stock has been stuck in a range for years. Now, this is very important to understand because markets don't move randomly. When a stock moves sideways for such a long time, it usually means one thing: the market is uncertain about the future growth and profitability and risk in the business. And if you connect this with what we just discussed in the financials, it start making sense. Yes, revenue is growing. Yes, the spending is also increasing, but profits are under pressure. Margins are declining and risk is increasing. So the market is basically saying, quote unquote, I am not fully convinced yet. Right now, the stock is again nearing its lower range, around 600 to 650 range. This has historically acted as a support zone, but it has also been tested multiple times. So if we draw this range, you will see that this is the range which it has always come to. So now, if you see the time it got listed, it was here. Then it went down, and then it broke this resistance and went directly up to 1150 range. Then it went down, it took support, then went up, then again went down, took support, again went up, then again on this range, then slightly up, then again on this range, then up, then again come to this range. So this is a very strong support range. So now we are at a very interesting point. Either the stock holds this level and start moving up again, or if this level breaks, we could see further downside. And that is exactly why this becomes a crucial zone to watch. This chart is actually a reflection of investor psychology. At higher levels, people were overly optimistic. Now there's hesitation. And somewhere in between is where the real opportunity might exist. So when you combine everything, a growing business, mixed financial signals, and a stock that hasn't moved for years, the big question becomes, is this a hidden opportunity before the next move or a stock that will continue to underperform? So that's my analysis of SBI cards. If you found this breakdown helpful and enjoy this kind of in-depth, no noise analysis, make sure to like the video, subscribe to the channel and share it with someone who might find this helpful. Also let me know in the comments what do you think about this talk. I'll see you in the next one. Thank you so much for watching.